Hey, Grateful Dad is here. Awesome. Kermit. It's always good when Kermit's here too. All right, let's get started here. Okay, welcome. This is Q&A 156. Thank you everyone for joining me. Really appreciate it. We've got a couple questions in the queue already, so if you got any more questions, fire them away. Fire away at them. Throw them in the chat, and we'll see how many we can get through tonight. I mean, hope everyone had a happy 4th of July, especially after the payroll debacle and the mess. Jeez, they did it again. Payroll headline wasn't all that great, saved by teacher jobs, and the market takes off with it, says, oh, this is fantastic. So let's start with your first question. I'm sure we'll get to payrolls and some of the other macro stuff. I was going to do a presentation like I did last time we did a Q&A on the consumer stuff, but I didn't have time to put it together. If you want to see the payroll stuff, I did it live YouTube, the replays on their YouTube channel. They went into all the details. Plus, I go over it in the weekly recap for today. We'll be talking lots of payrolls for going forward. And really, it's not really about payrolls. It's the unemployment rate. I mean, the unemployment rate ticked down for all of the worst possible reasons. The numbers are absolutely huge. 750,000 former American workers dropped out of the labor force in the last 2 months combined. Just a complete crap show. So the Grateful Dad, we'll start there. Treasury Secretary Bessent's increased T-bill issuance will increase repo collateral supply, therefore dollar supply. Well, not dollar supply. I know what you're saying, and you're correct. It's the dollar circulation, right? The more collateral there is, the more cash can actually move. And there is, I mean, depending on how it works and where it comes from, more collateral supply can lead to the creation of cash and then move it, but it's really about motion and circulation. But I know it's exactly what you're saying. So the more collateral supply there is, in theory, it should be better for the monetary system because there's more key ingredients that allow the system to continue to circulate and be more elastic and flexible as it does so. The problem with Bessent's T-bill supply is they're running up against the debt ceiling. We don't have any idea how much of a resolution or what the resolution might be. And now we're seeing the 4-week Treasury bill rate really rise sharply, which is the market getting into that 4-week window or 1-month window where, money market funds don't want to be exposed to any potential instruments or any instruments that could potentially come due during this debt ceiling issue. The 8-week bill has come down again. So the market's still saying, hey, there's going to be a debt ceiling problem. And as there is no resolution to it, whatever the Treasury Department wants to do in the short run, they're not going to be able to do. They're going to have to continue to scale back on Treasury bills because that's the variable, the plug line in the Treasury's deficit financing financing tactics. So they're going to continue to scale down bills as long as there's no resolution in the short run. But as far as the longer term, there's always two variables to collateral sufficiency as far as circulation goes. Supply is one of them, but the vastly more important one is the willingness and ability of dealers to recirculate Treasury bills. So there can be a ton of supply, but if dealers are risk averse, it won't matter. In fact, the collateral multiplier, which we have no idea what the collateral multiplier is, we just don't have near enough information to come up with it. We just know that there is one. But in the collateral multiplier equation, if we could ever find out what that is, the risk aversion, the smaller change in dealer willingness to do dealer activities to recirculate collateral has a much larger impact than the Treasury supply, whether they're supplying more or supplying less. So whatever the Treasury Department does in a ceteris paribus world, which unfortunately we don't live in one, but in a ceteris paribus world, the more that the Treasury Department leans on issuing bills, the better off it would be if there weren't all these other considerations. But I do, Grateful Dad, Steve and I were laughing about this a couple weeks ago, not that long ago, because Bessent was a big critic. I mean, he was talking about ATI or activist treasury issuance, that ridiculous idea that was put forward by, who was it, Nouriel Roubini. Last year, it was last year, in the middle of last year, the idea that Janet Yellen was purposely doing a stealth QE by not issuing more 10-year treasury notes, instead focusing all of the treasury issuance up at the front end. And then as soon as Bessent becomes Treasury Secretary, he's like, yeah, we're going to continue doing the same thing. It's not political. They always want to make it out to be political. It's the market. The market says we need bills and we need more bills. And that's what if you haven't seen our Eurodollar University video on collateral circulation, part 2 is coming up hopefully this weekend. where we're going to talk about this very idea. Why does collateral need to circulate as much as it did? In part one, we talked about why there needs to be more collateral as far as treasuries. I mean, why there's securities lending and all that stuff to begin with. So the upshot here is that, yes, the Treasury Department overall is still leaning toward Treasury bills, but even then it might not be sufficient in either a long run or a short run period. Short run, especially when the debt ceiling becomes a pretty substantial constraint. And it's really the overriding factor. Not supply is unimportant, but the overriding factor is always risk aversion. And so we saw primary dealers in particular, the primary dealer weekly survey that comes out from the Federal Reserve Bank of New York, which, by the way, the primary dealer survey is the Federal Reserve's attempt to illuminate some of these collateral dimensions. Not that they do anything with it on a policy level, but at least they give us some information and some insight. Primary dealers, as I pointed out in a YouTube video last week, they have been stacking Treasury bills, which is something that they usually do, not always, but they have done more times than not in the last couple of years in anticipation of something going wrong in this area. Whether or not that's maybe they're anticipating collateral scarcity due to the debt ceiling that we're talking about here, that the Treasury Department has to pull back in the amount of bills it issues in the short run over the rest of this month and into next month, that's a possibility. We saw primary dealers really build up huge bill inventories just before the bank crisis in 2023. They did it again last year, just before the breakout of the carry trade blow up. They did it again this year, just a little bit before, a little bit more of a lead time there. But they stack up bills anticipating this type of problem, and that's what we've seen over the last couple of weeks. Though their inventories did decline in the latest weekly data we got for the final week in June. So we'll see if it goes up again in July. But either way, Treasury bills, even though the government wants to supply more, there's a lot more that goes into it than just the supply. Like I said, I think supply is overrated as far as a factor. It's really the other stuff that really matters. Kermit asks, do you think QE will be restarted this year? And I don't think it will. I don't think we'll see QE from the Federal Reserve for sure, or from many other central banks. Unless something drastically changes between now and the end of the year, which is certainly possible, because we're still looking at that long run picture where the swap market says rates are going to go down a lot and stay there for a lot longer. How do we get there? Well, we could get there with a very quick, sharp deterioration in the second half of the year. And if that does happen, then you would see, for example, the ECB, which is already very close to they're already at 2% to begin with. They're likely going to cut more in the second half of the year, so they're going to be under 2% anyway. And central banks are taking a slightly different approach to quantitative easing than they did back in 2008. In fact, I did a video on this just today about ZIRP as well as QE. They originally started out with the tension on QE and zero interest rate policy was basically a crisis measure. We get the financial system corrected, we get the economy back on track, and then we never do these things ever again. Obviously, we know it didn't work out that way. And because it didn't work out that way, central bankers have, over time, realized that the world is in worse shape than they thought it would be. Therefore, rather than being a one-time application of QE and zero interest rates, maybe we're going to have to do this repeatedly. So some central banks, including in Europe, the ECB, have said they're not going to wait to go back to zero before they do a QE. So I don't think that means that, given the current circumstances that we see in Europe, though they are getting more negative indications there, don't necessarily see QE based on what we see today. We can certainly see a couple scenarios where things really deteriorate sharply, and that changes everything. But as things sit right now, right this moment, I don't think QE in 2025 is a realistic possibility, given where everything is. But the nonlinear world that we live in, things change very quickly. I mean, the deterioration in the U.S. labor market. But even so, I think it would take the Federal Reserve a long time to, first of all, cut rates. They're at what, what are they at? 4.75%? I don't even remember. They're down 450 at the upper bound. So they're at 450 at the upper bound. I mean, they've got to cut down, more than a couple hundred basis points just to get within range of 2%. And I don't think they will use QE before they get to 2%. I mean, yeah, they could do 75 basis point rate cuts, but then even so, you're talking about 3 of those before they get to anywhere close to QE, what I think they would trigger a QE. And to do 375s in a row would be, I mean, absolute chaos and panic. So I don't think we'll see QE in any really major location this year because the bias is still toward inflation. The bias is still toward, hey, everything, we'll just see how it works out. And it's going to take some time at the very least, even if things do start to accelerate to the downside more than they already have, it's going to take some time for central bankers to see that it happens, interpret it that way in the data, and then start to react to it in a way that at first, I mean, the first step, they never want to panic, they never want to take it too far. So there's a meeting where they undercut, they're not going to do something substantial. The first meeting, that takes another meeting. So I don't think there's enough time in just the second half of this year that we see a QE among the major central banks in the world, assuming that we don't have a serious real acceleration in the second half of this year, which is unfortunately still a possibility. I wouldn't say it's a base case, but it's certainly a possibility. Dubious. Why would there be an increase in refinery utilization but drawdowns in inventory where the latter is below trend on a seasonal basis? Yeah, it's something we've been going over, not just in the daily briefs, but also at Eurodollar University's deep dive analysis, is that there's a substantial systemic change underway in the energy marketplace. Now, some of it, we have to pay attention to criticisms of the Energy Information Administration, or the EIA's data. Some people say it's flawed, and it very well may be, but it's basically the only statistics that we have outside of the other, what's the other side, the AIP. But either way, what seems to be happening, and there is corroboration outside the EI, we can argue about the degree of this happening, but inventories continue to run lower and lower and lower. And that seems to be, in fact, I'm pretty sure it is a choice by the energy market participants. If you go back a couple of years, we're complete opposite ends of the spectrum because a drawdown in inventories led to tremendous volatility in price and fears over supply shortage, which, substantial backwardation in the marketplace or contango in the marketplace. So there was this desire for the energy marketplace to build up a higher and higher cushion of inventories in case that supply was disrupted, whether it be, spreading war, conflicts, any number of things that have happened since then, OPEC problems, OPEC not exacerbating the situation with production cuts. There was this desire to have a higher cushion of inventory just in case we had supply disruptions, which were a very real thing. But over the couple of years, really since 2023, and it really started last year, inventories have been draining lower and lower on a systemic basis, not just a seasonal basis, as energy market participants are becoming, first of all, more comfortable not needing a higher level of inventory because they don't think there'll be a supply disruption. But vastly more importantly, given where prices are and where they're headed, the market has said, there is basically zero chance that demand actually in an unanticipated fashion increases sharply. So what are we holding all this inventory for? Back in 2022, you could make the case, well, it seemed like the economy is going to hold up relatively well. Plus China was going to come roaring back from reopening. We better have enough inventory in our storage capacity and facilities in order to meet this potentially roaring demand for this global economy that once it gets its footing after 2022 and the adjustment there, everything's going to take off from there. So one of the big changes here in 2024 and 25 is the realization that's not happening. And the oil market itself and everybody across it, including those in OPEC, the producers, are saying there's no threat from demand, so we can just run refineries as much as we need to. We don't need to put it into inventory. We can just keep relatively low levels of inventory simply because we have zero threat. We have very little threat from supply and even less of a threat from demand. Plus, we're looking at demand and it's not growing anywhere near what we expected even last year. And the new estimates are probably going to be over optimistic. So everybody's just running on lower and lower inventories because the demand equation has completely changed and supply has largely been taken off the table. So there's a lot of stuff going on in the energy market that's structurally related to forgot how to grow at the very least, but maybe even doing worse than that. Robert asked, do you think when the recession hit, depending on how serious it becomes, we'll see bailouts and social unrest? God, I hope not. The problem is, and there's another part of the question here from Robert, is the credit market going to seize up if tariffs and unemployment continue to rise? That's potentially the problem. Let's take these two different parts because the credit market is a different part of it. But if there's a recession, and that's still an open case and an open possibility, you see deterioration in the labor market, but it's not the it's not the type that would confirm most people's perceptions of what a recession is. So nobody wants to talk about the R word. We talked about it back in April, and then it didn't happen. So, a lot of people have said that it's, just a bunch of fake news. Nothing ever goes in a straight line to begin with. You also, recession, even traditional recessions, the V shape in the post-war, what you see is not a single shock, but you usually see a repeated series of shocks that get bigger and bigger and bigger as they reverberate back and forth. So it's not unusual to get this back and forth before you get into even a traditional recession. But we're not in a traditional recession environment to begin with. We've been forgot how to grow for forgot how many years now. So there's already a unique set of circumstances. But the real question is, if this continues to get more and more serious, regardless of whether anybody wants to call it a recession, we still see unemployment rising. We see economic activity falling. We see businesses being squeezed at the margins. Input costs are going up. They don't have business coming in. Therefore, they have to do something. I mean, the labor market statistics I just talked about today in today's weekly recap, in case you missed it. While everybody was fixated on the headline unemployment rate, average weekly earnings were down for the second time in 3 months, which is highly unusual, especially the degree of decline in the second of those months, which was June. So on a 3-month basis, nominal average weekly earnings in the U.S. labor market were fractionally negative. But that's the first time they've been anywhere close to negative since August of 2020. So there is very substantial weakness going on in the labor market. Whether or not everyone agrees that it's a recession is a completely separate topic. It really gets into semantics. But will it lead to the type of situation where we get to, as Robert is asking, bailouts of banks and social unrest? I mean, I can't answer the second of those. I have no idea what will lead to social unrest. As far as bailouts and banks, I don't think we'll see it. I don't think we'll see any failures, let alone bailouts, in the regulated banking system. Shadow banks, which gets in the second part of Robert's question, may be a completely separate story. I did a video on this on YouTube. When was that? Last month, when the tick data came out, and what it showed was that back in April, what happened there was, and why it didn't get worse than it did, wasn't because of the Fed, it wasn't because of government, it was because, as always, U.S. banks through U.S.-based dealers become the lender of last resort for basically the entire world through the repo market. So you've seen a huge surge in repo cash going out of U.S. banks to the rest of the world, with the vast majority of it, according to the tick figures, going to shadow banks domiciled in the Cayman Islands, which is shadow banks, that's investment funds, all the stuff that we've been hearing about over the last year or so. So they got themselves into liquidity problems because, I mean, let's face it, they're basically funding their operations with questionable collateral. That much we do know. There's probably for collateral swaps problems that are going on, but the tick data purposely avoids all of those. So we have to make some inferences, but it isn't that difficult to see and infer and draw some reasonable conclusions about what happened in March and April. Was that the most shocking part of the tick statistics was that in April itself, the collateral that came back as U.S. banks were bailing out all these shadow banks around the world wasn't treasury bills. It wasn't treasuries at all. It was actually likely junk, which means that we would have to accept that dealer banks were accepting crappy collateral during a meltdown for voluntary reasons, or because they thought they were optimistic, or they did so because they thought, oh crap, if we don't supply funds on the crap collateral because these offshore shadow banks can't get their hands on good collateral, things are really going to fall apart. So from that, and this is my own inference, obviously, this is my opinion, from the data that I've seen and also going through what happened in April and looking at all the information that we have available and putting it all together, it really seems like at the last minute, dealer banks stepped in and said, we're going to lend on shitty collateral to these shadow banks because we don't want to risk what will happen if we don't. So what that means is that moving forward, if we get into another situation like that, well, you think it might be more likely the dealer banks do the same thing because it came to a successful resolution. But in many ways, it only came to successful resolution because there was the catalyst from the Trump administration announcing tariff delays that basically took a lot of the pressure off. It wasn't actually the bailout by dealer banks of these shadow banks that led to the reversal, the eventual re-risking in the marketplace. It actually came from, an exogenous factor from politics, non-economics. Do you risk doing the same thing the next time if there is a next time? Because as we've seen in these crisis periods, dealers become more shy, not less, even as they go through these events and nothing really catastrophic happens from them. So long answer to your question here. If credit markets are going to seize up like they did in April, we have an issue with shadow banks. And then therefore, if we do see something substantial happen with the shadow banks, how much of that comes back on regulated banks? And as that happens, do regulated banks start to protect themselves with doing some things with collateral? I don't think it leads to, we have failures among the regulated banks that are bailing out the world. I think it does lead to more and more problems. Whether that leads to failures of some of these investment funds remains to be seen, but they are on a very short leash to begin with under these situations, and they have some tenuous capacities and capabilities to fund themselves in these less than ideal circumstances. So that's the area I think that we need to watch. And if we do see tariffs disrupt everything even more, or if we see unemployment in the United States and the rest of the world continue to rise and gets to the point where, once again, the marketplace is afraid of the R word, then we could see a repeat of April and then really test to whether or not everything that I'm saying actually becomes true, whether banks are willing to be the lender of last resort in the case like that. So do I have an answer to that question? I mean, I don't have an answer to the question. I think that's something we just need to watch and focus on very closely, given what happened in April. Which all of this, again, going back to the swap market, that's really the background that we have. The swap market basically says, and really all it says, is that interest rates are going down and they're going down to stay there. How do we get from here to there? Well, everything that Robert is asking is in line with that, so we can't rule it out. And given what we saw in April, it's probably a higher probability than we wish it would be. Now, whether that gets to social unrest, I mean, I have no idea. I couldn't possibly answer it, but that would certainly be consistent, as would some of the less catastrophic, less horrible types of scenarios. If we just keep going the way that we are, just the forgot how to grow economy, it gets a little bit more forgetting as we move forward, that could still lead to what the swap market is pricing as far as the future interest rates. And by the way, today's YouTube video, which isn't coming out yet, I still have to finish that. Today's YouTube video, we're talking about, as I did in deep dive analysis yesterday, the Federal Reserve Bank of New York came out with a post. It wasn't an official study because they've been keeping this information for quite some time, but it was a post that shows, according to their view of forward rate markets, focusing on forward rate markets, not swap markets, they cannot rule out a zero interest rate policy coming back in the US over what they say is the intermediate term. So a 7-year period, they calculate a 9% chance that the Fed's back at zero when it really should be, when it should be a 0% chance that it happens. So if you want all the details, that's in today's YouTube video. But that's another signpost along the swap market. The Fed saying we can't rule out a zero interest rate policy, even though we would like to, is consistent with interest rates that likely go down a long ways and stay there. So all of this stuff does add up. We just don't have any clarity and visibility on exactly what that means. That's what's really frustrating about all of this, is that we have an idea what the future looks like in the language of interest rates, but no idea, no real idea of how we get to that point. That's the problem. That's one of the problems. Back to dubious here. Artificial distortions of supply constraints have understandably captured our attention. What characterizes typical small E economics supply problems beside the post-GMC 2010-2011 supply shock? Oh, the one before the GMC. And I like how you use GMC. Thank you for doing that. I really appreciate that. It's a great monetary crisis, not financial crisis. The supply shock before 2008 that led into the surge in oil prices. People to this day still don't understand why oil prices were surging in 2008, given the fact that we were in a deflationary environment. That was an small E economics supply shock. For the longest time, Saudi Arabia, and to a lesser extent its cartel partners, had been, from the 1970s on through the 1980s and really into the 1990s, Saudi Arabia was the marginal shock absorber for the entire global oil supply. What that meant was when there was an oversupply, Saudi Arabia would rein in its own production and keep prices relatively stable. If there was an undersupply, like we saw in the Iraq War, the first one, the Gulf War in the early 1990s, the Saudis would step in and supply more oil. But as the euro-dollar worked its magic along with the great moderation, the innovation that happened, prosperity showing up all over the world, especially in emerging markets like China, suddenly demand for energy continued to grow. Remember the peak oil? Everybody's talking about peak oil by the middle 2000s. That was related to all of this. Demand was growing faster than supply. And remember, the U.S. supply was stagnated and declining because of, ever since the 80s and oil prices going down, there was no incentive to invest in oil. So Saudi Arabia's ability to be the continued shock absorber to the world got eroded more and more, especially as the Chinese economy really developed and grew, which meant the demand for oil kind of detached from Saudi Arabia's marginal supply abilities. And so it was a supply constraint because it takes a long time to get oil supply on the marketplace. And as demand continued to outpace supply over the years leading up to 2008, then you had some of these non-economic supply concerns that piled up too. In early 2008, it was almost comical how many supply shocks there were, mini supply shocks that were just adding up at the worst possible time. So you had this non-economic imbalance where demand was simply growing faster than supply, and that wasn't even corrected until the middle 2010s when U.S. shale oil production finally showed up. So there are small e economic supply shocks and imbalances, and we've seen them before. I don't know if you're asking, Dubious, whether or not we'll see one again in the near term. I don't think so, because like I said, I think the energy market is looking the opposite way. Maybe the energy market's wrong, but the rest of the market's just thinking the same way. We're not going to see anything out of demand for the foreseeable future. So I don't think we're going to see something like that happen again, which is one reason why the oil market is saying we don't need inventories. But you see these mainstream media articles talk about tank bottoms are visible and Cushing. The oil market participants are like, yeah, that we want it that way. We don't need to carry supply. We don't need to carry inventory. Inventory is expensive. Inventory is a pain in the ass. You don't want to carry inventory unless you absolutely have to. So trimming inventories down to relatively low levels, in fact, historically low levels over the last 10 years, it makes sense in this environment when you step out of the Federal Reserve's strong, resilient economy nonsense. It all seems to happen there. In the future, Robert again, in the future, do you see banks being replaced as intermediaries? Yeah, and that will be such a good thing. Now, when we're talking about future, we're not talking about tomorrow or next year, or maybe even the next half decade. It's going to take a while to get there, but that's what cryptocurrencies are. We run the entire monetary system works on a virtual ledger system. But it's not a single virtual ledger system. It is what the Eurodollar actually is a telecommunications network whose purpose is to integrate ledgers. We have all of these little individual ledgers from every individual bank. You have larger ledgers through correspondent networks and correspondent relationships, some of which in these days in the telecommunications technology we have available, they're ad hoc networks. They're not like they used to be where they were hardened correspondent system like in the 19th century. I mean, you look at what the SWIFT system really is where you have, what do they call them, corridors. These corridors that come together and just have a bunch of like 7 or 8 or a group of 10 banks that just suddenly start to communicate because they all have some short-run business together. So they're integrating ledgers on a small scale basis that then integrate into larger ledgers, which integrate into larger ledgers that go through financial utilities and financial markets. And it's an extremely complicated process, but that's the way the system needed to develop because otherwise there was no other way to have globally mobile and flexible money. So we have all of these ledgers stacked on one another. Would it be easier just to have a single ledger? And the answer is, of course, yes. The real problem is which ledger is going to be the one that we use? How flexible will it be? Can it be widespread and usable enough that it fulfills the roles of a global reserve currency? And I happen to believe that over time that will be the case. And as we move to a single ledger, that basically removes the need for banks, because banks are not storehouses of money. We don't use money. Nobody uses physical currency, not in any substantial quantity. So everybody thinks in their head that a bank is this big, gigantic fortress-like building, or at least it's a corner storefront in a major metropolitan center or something like that. But at least it has ATMs that are secured, and it has vaults filled with cash, and there's armored trucks that come around. No, that's unimportant. What a bank really is it maintains a ledger. It's a bookkeeper. If we have a single ledger or just a couple parallel ledgers, which probably will be the case, we have a couple of parallel ledgers on parallel networks. We don't need individual banks. We don't need banks at all. We can have intermediation functions performed by just ad hoc groups, businesses. We have that sort of already. But to answer your question, yes, the intermediaries that we have, The intermediation that's done has been done by the banking system because the banking system was the only way to get to this point. This is what we went over in, first of all, a couple of presentations I did in the Eurodollar University member section, if you haven't seen them, but also the Let It Flow series, especially part 3. We went into the evolution of how we got to this and how important banks were in leading to this situation. But once we continue to evolve beyond here, get into these other ledger systems, we don't need the banking sector at all, and that will be a tremendous positive for the economy because at this point, banks are a cause of friction and a drag on productivity over the overall economy. So replacing them should, at the very least, not in ceteris paribus terms, but in real terms, remove some of those constraints and lead to, especially with the adoption of a different monetary system, lead to a better long-run future. So we should celebrate the end of the banking sector, which, by the way, I think a lot of individual banks, at least some of the smarter ones, know this is going to happen, which is, some of them expressed their dissatisfaction over, was it Jamie Dimon a couple of years ago talking about Bitcoin as being, I forget what the exact words, but he was hostile to Bitcoin at that point because I think he sees the writing on the wall here. Let's see, Grateful Dad yet again. TLT has not been below $81 for at least 26 years. What macro scenario would cause the bottom to fall out? U.S. Treasury valuations? If you're talking about the U.S. Treasury bonds, there's always this underlying undercurrent of discussion about how the 40-year bond bull it has to end, right? It can't possibly continue to go. But that's looking at the Treasury market and the Treasury system from the perspective of investments, rather than looking at Treasuries as I believe more properly, balance sheet tools. Now, yes, there's fundamentals that go into it, but that balance sheet tool kind of changes the relationship here, where it's not strictly about investment prices, it's really the needs of the overall monetary system as a whole. So what would really cause Treasuries Treasury interest rates to rise and Treasury prices to fall more than they have, the Fed pushing up the short-term rates over the last couple of years, what would really happen there, and this is where Bill Gross, of all people, was correct when he first proposed this way back in 2013. If you don't remember 2013, if you're a lot younger than me, I remember 2013 vividly. During the taper celebration, because it was a celebration, just look at swap spreads. But during that period, Bill Gross made his famous call that it was the end of, back then, the 30-year bond bull. And he said the reason why it was the end of the 30-year bond bull was because the economy was picking up. Therefore, he got this right. Growth and inflation expectations would pick up. And as they did, longer term, Treasury rates would rise, and so would other interest rates on other asset classes, which would be exactly what we want. Higher interest rates for these fundamental reasons are not a bad thing. Now, it would be bad if you're holding TLT, but if the fundamental picture actually does change, where we don't have this constant interruption in collateral flow, we actually have legitimate and sustainable economic growth as a possibility more than just these short-run reflationary periods, that will completely change and completely rewrite the bond bull, which doesn't actually exist. The fundamentals shift, suddenly interest rates go up, and they stay up, and they continue to go up, not because the Fed's pushing them, but because the market is selling safety and liquidity, looking for better returns on a risk-adjusted basis where the risks are going down. So therefore, the risk-adjusted returns get bigger and bigger and bigger. Opportunities in the real economy go way up. And therefore, who the hell wants to own relatively, safe assets that don't yield really nearly enough? So that's what would cause everything to really shift. It would lead to the end of the bond bull market, even though there isn't really something there. And Grateful Dad says, I'm trying to quantify the risk reward of continuing to accumulate here in the mid 80s in my long-term portfolio. What I would say there, and again, I don't give specific investment advice, is simply that swap market says rates are going lower. And so far, and this goes back, 20 years, the swap market has been not spot on, not perfect, but as good as it gets in terms of describing the long-run future. Now, there's fluctuations, there's all sorts of stuff that we need to sort out. We need corroboration from other marketplaces. But the swap market, which is the most important market that exists that no one even knows about, which they really should, says that rates are going lower. So from that perspective, whatever everybody's talking about in the short run, whether it be, Treasury debts are going to be out of control. I mean, how many can it get even more out of control than it was 2 years ago in 2023? We didn't see skyrocketing interest rates then. Inflation is coming back, or whatever Sell America. Sell America is the latest one. The Sell America narrative that only shows up in the euro. Whether that people can talk about these short run factors and say that interest rates are going to rise. As long as the swap market says we're low spreads and really low spreads, that's a high degree of confidence from that huge part of the marketplace that rates are going to go lower. They're going to stay there for a lot longer. So in the long run, what you're proposing makes more and more sense. I don't know if my chat is behind or if that's the end of the questions. Maybe I'm just behind. All right. If there are any more questions, let me know. Otherwise, we'll just end it here. One of those Thursday type of things, huh? Or Tuesday. What day is it? Today's Tuesday. Maybe my stream just isn't uploading. I should probably show these. Yeah. All right. I think that we'll just end it here. Great seeing you as always. We'll do this again on Saturday, assuming people show up to that one. And we'll do a pre-recorded next week, but that's going to do it for 156. Really appreciate everybody who did stop by and all those people who will watch this later on a replay. But thanks everybody for showing up. I'll see you again very soon.